Advanced Financial Accounting. In this presentation, we're going to work a practice problem where we have one company that's going to fully purchase the net assets of another company by issuing common stock. In other words, we have two companies involved here. One company we're going to call P Company. The other company we're going to call S Company. P Company is purchasing the net assets. They're going to purchase all the net assets of S Company. They're going to do so not with cash, not by issuing debt or bonds, but by issuing common stock. Get ready to account with Advanced Financial Accounting. Here is our information we will use with the practice problem. We're going to have information with regards to P and S. These are going to be the two companies involved. P then purchasing S. So P's information, S information. We then have the balance sheet down below. When thinking about this types of information where we have a purchasing taking place, then we often need to think about, all right, are we talking about book value information or are we talking about fair value information? I would typically think of that by thinking of, is there a transaction that's happening? If we're talking about a subsidiary kind of relationship or a purchase or something that's being created, are there two people involved, two entities involved, where there is a negotiation process? If there is, you would think that the regulations would typically want to have a revaluation at that point in time to the fair value. So that would typically be fair value, as opposed to if P was simply to create another company and push off some of their assets and liabilities to it, that would be more like a restructure. No negotiation has taken place. There's not really a basis on which to revalue the information to a fair value because no arm's length transaction, market transaction has happened. So here there is going to be kind of a transaction, right? P's basically purchasing S, purchasing the guts. You could think of the assets and the liabilities of S. So therefore, on P's side of things, we're using the book information, which is basically going to be our trial balance. We're going to be considering this from the perspective of P. So if we are P, then we're going to be saying, all right, here's our book value information before. P's not the one being purchased, so obviously we're going to be considering them at their book information, the starting point, and then thinking about what will happen in the purchase process. Then when we move over to S, then the question is, all right, do we take S's book value or fair value? This is the point in time where we're saying, well, P's basically purchasing line by line the information, assets, and liabilities from S, and therefore we should think that there should be some renegotiation happening during that process, taking S's information from a book value to a fair value. Note that when we do that, obviously cash is going to be the same. No change really there typically, because cash is cash. Inventory, however, will be different. We're going to have to revalue inventory. In practice, this is not an easy process, right? And this is why this whole this kind of purchasing technique is not the easiest thing to do, because you're going to have to negotiate basically the fair value of each line item, and when you take into consideration taxes on top of that, it could be a difficult thing to get down pat, right? So we got the inventory. We've got the depreciable assets then, which is also something that often will differ from what will be on the book value. Also note that when we think about the fair value, we're not going to be putting accumulated depreciation on the books for fair value. We're basically thinking about, all right, what's the net asset worth right now? So in other words, in the book value, you have the book worth of the fixed assets being this 261 cost minus the accumulated depreciation. When considering that on a fair value basis, we're just going to fair value the equipment. Obviously, we would have to do that on a line-by-line basis. So in practice, of course, we would actually have to think about the equipment, the subschedule, the building, the equipment, and all that kind of stuff that's depreciable, and then revalue each of them. So it is a tough job, but that's going to be the idea. From a conceptual standpoint, we want to revalue all of that type of information. Then we got the total assets here. We got the liabilities. Accounts payable is going to be the same in this case. That would often be the case if, because you owe money. If it's basically owing money, then it may be the same. It may differ in some cases. Notes payable is $34,000, so we have a difference there as well. So what we want to do then is take this fair value information that we will be purchasing, and I'm usually considering this from the purchaser's perspective. So when I start saying we, I'm usually meaning that we are P. So I tend to look at things from the purchaser perspective. Okay, so if P is purchasing, then we're thinking we're going to purchase the fair value of this information, and we're going to be purchasing these items. How are we going to pay for that? Well, we're not going to be issuing the cash this time, or we're not going to be paying cash this time. We're not going to be taken out debt to pay for it. This time, what we're going to do is issue the stock. So P acquires all of S assets and liabilities for its common stock. P issues 8,400 shares, and P shares selling at $60. So we're going to issue 8,400 shares. Now you might think, well, if I issue 8,400 shares, notice that neither side of these transactions now is the easiest thing to know exactly what the value is from a market perspective, as opposed to if we paid cash, it would be easy for us to just say, cash is cash. At least I know how much was paid in terms of our measuring tool, cash, right? In this case, we issued the common stock, so we have to basically know what the value of that common stock is. If it's traded on a stock exchange, then we could figure that out. If it's not traded on a stock exchange, it could be a little bit more difficult when you think about the two sides of this consideration to think about, what's the fair value of these two sides of things. So what we're going to do then is now take this fair value of S, and this is going to be the information from P. So this information over here is P's book value. We're going to take P's book value and then record the purchase of S's fair value. So we're going to be looking here at this column, and then we're going to have our trial balance. So here's our trial balance, beginning balance, entry, ending balance. Here's P's fair value column. And then we're just going to list everything out. Once we've revalued everything, the journal entry is pretty easy at that point, although long. So we're going to say, all right, cash is going to go on the books at the 97,000, no problem. So we had the 156,000 before, plus 97,000 brings us up to the 253,000. The inventory is going to go on the books for the 166,000. That means we had 313,000 before, plus the 166 brings us up to the 479,000. Then we have the depreciable assets going on the books for 249,000. So we had depreciable assets before of 612 plus the 249 brings us to the 867. We're not going to be adding any accumulated depreciation because we're putting it on the books at the book value, just kind of like if we purchased it at this point in time, right? It's a transaction, purchase type of transaction. Then we're going to go to the accounts payable. We're going to be adding those, meaning it's going to be a credit to increase the accounts payable. We were at 57,000 before, plus the 40,000 brings us to the 97,000. Then we have the notes payable, the 37,000. We're just pulling over this information from our fair value. That brings us up to the 233 from 199,000. Then we have the common stock that's going to be issued for the 67,200, and then the difference is going to go into the additional paid in capital. Now the common stock, this one is going to be for the amount of common stock we issued, which in the prior slide we saw was 8,400. And we're saying the par value is going to be, again, this was on the prior slide, the $8. So times $8. So that's going to be the 67,200. Now you might say, hey, look, this additional paid in capital, we should just be taking what we got. Like if we think about this from a transaction now, you might say, hey, look, we got 97,000 cash plus 166,000 worth of inventory plus the 249,000 of fixed assets minus the liabilities we incurred, 40,000 accounts payable minus the 34,000 of the notes payable. That means we got net assets of the 438,000. So you might think, hey, look, we revalued everything to the 438,000. This additional paid in capital should just be the plug, to whatever we need to basically be in balance. In other words, you would think you take that 438 minus the 67,200. But that would be assuming that the fair value of the net assets of company S that we are purchasing is all that is there. So, and that's not necessarily the case, because even though we revalued everything to the fair value, and therefore this should represent the fair value, and if we were to purchase just what was on this fair value balance sheet of S, then you would think that would be the case. But there could be something not on this balance sheet at all. So it's not that we didn't fair value it correctly. It's the fact that the balance sheet doesn't represent something. That something is what we call goodwill, intangible, future earning potential that's not on the books. Where does it come from? Because of the brand name or something like that. There's future earning potential that is there that is above and beyond the net assets. So therefore, we can't just figure out what the common stock is based on the net assets that we figured out up top, right? And again, the common stock is something that we're going to have to then value in and of itself. And that's why the book problem gave us, this problem gave us the information that it's worth $60 a share. So $60 a share is what the common stock is worth. So then if we took the 8,400 shares times 60, where would we get that in real life? Well, if it was publicly traded, then we would be able to see what it is, or we'd have to value it if not, so that we can get that, and then we'd figure out what the goodwill is. So in other words, just the 504, or in other words, if we took the 67,200 plus the 436,800, there's the 504. So now we got what we purchased, net assets, assets minus liabilities, and then the 504 is what we gave, right? That's like the cash equivalent to us paying cash, right? We gave something worth $504,000. So then the plug then is going to be goodwill. So goodwill is the difference between what we got. So that's the debit we need in order to make this in balance. In other words, if I took all the assets minus these liabilities minus what we paid, then we would say that we had goodwill, some type of thing that we paid more. In other words, the value of the common stock that we issued was higher than the net assets that we got, even after revaluing the net assets. Why? Because there's something not on the balance sheet, something intangible, something that somebody is actually willing to pay for at this point in time in a market transaction with unrelated parties negotiating. That's something we're going to call goodwill. So the goodwill then is going on the books at the 66,000. So notice that goodwill is something that's going to be created, during a transaction. So you might say, where was that goodwill before? Why couldn't we put that goodwill on the books before this point in time? Because you wouldn't know what it is. And if you give the power of an internal organization to revalue their books all the time, which is an estimate based on what their best guess is, then the goodwill kind of fluctuates. So there's kind of debate as to how to revalue or how much fair valuing you can do without an actual market transaction. But when there is a market transaction, then that's an opportunity to reveal through negotiation true valuation with the use of the market. So here's basically going to be our ending numbers, of course, for now P company. Consider this from a P company perspective. We'll look at S company in a future presentation to see what would happen to S, but obviously from S company's perspective, they would basically be gutted, right? Everything, all their internals just got removed because they just transferred it all out. So after this transaction took place, S would in essence be a shell that is now holding on to the common stock and the additional paid-in capitals, but doesn't have, the guts of everything else that they were owning. And then you'd make a decision as to whether to liquidate S at that point in time and distribute the additional shares to basically the shareholders as one option at that point.